All right. Good morning, good afternoon, traders. Today is Friday, May 30th, 2025. This is You've Got Options for Income Navigator. And today we're going to talk about hedged income trades. We're going to look at a position that I added today. On my screen right now, I have a position that I am considering adding. Um, this is my tier one. So the position that I put on today was tier four. This was the last of the tiers. I'm going to carry four tiers, tier one, two, three, and four. I did not get a chance to put on the trade last week on Friday, so I waited until this week to add tier four, and now I have tier one, which is just leftover put debit spread. Tier two is a 1-1-1 structure. Tier three is a 1-1-2 structure, and today's tier four is also a 1-1-2 tier structure. So what I wanted to talk about first, and this is something that not many uh, think about or talk about, and I think this is very important and needs to be addressed. And this is not to scare anyone, but just hopefully I will get you guys to think about risk from a different angle here. And the word I am going to use, you've probably heard me say this before, is notional risk, right? Notional risk is the risk, right, that the position carries. It's not necessarily, the amount of dollars you have at risk right here and then, but the notional risk in options trading refers to the theoretical or potential risk exposure based on the notional value of the underlying asset in an options contract, right? So the notional value is the total value of the underlying asset controlled by that option contract, calculated as the underlying asset's price multiplied by the contract's multiplier. And I'll talk about it in this example. Notional risk represents the maximum potential loss in the value of the position if the option was to expire worthless or move unfavorably, though the actual loss is typically limited to the premium paid for the option. And that's, if we're talking about buying options, or the margin or collateral if we're talking about selling options. Notional value of a contract that, let's say, we're buying, if we bought, right, if we bought a contract, and let's not talk about ES, but let's just talk about equity, right? Because equity contracts have a multiplier of 100, so it's going to be kind of easy to figure out. If we bought a call option for a stock trading at $100 a share with a multiplier of 100, right, our notional value is $10,000. It's 100 shares times 100, 100 being the strike price, right? So, and that's the notional value of the contract is $10,000. That's what's at risk. We can lose 100% of the value of this contract if that call option that we're buying is out of the money at expiration, right? So that's pretty simple. We know that the risk is defined. We know exactly what's at risk. Now, when we talk about selling options, right, we don't always have to put up the full value of the contract. As a matter of fact, some brokers require so little that could potentially lead to a disastrous outcome. But if we're talking about selling options, let's say that same example, right? We sell let's say stock is trading at 200. We go out, 100 points out of the money, and we sell a 100 put, right, for, I don't know, maybe 20 cents or something, right? It's 50% away out of the money. So it probably doesn't have a lot of value. But in any case, right, we're selling a 100 put. It's 100 times 100 shares. So the notional value of that contract is still that same $10,000. Now, when you're selling this put naked, chances are your broker isn't going to ask you to put up $10,000, right? They may ask you to put up $200, right? If you're collecting something as little as 20 cents for that contract, maybe the broker is going to ask you to only put up, a couple of $100, maybe $1,000. But even then, even at $1,000 buying power requirement for selling that 100 put naked, right? You're getting about 10 to 1 leverage, right? You're holding $10,000 worth of, right? That's what the value, that's the notional value of that contract. You're holding $10,000 worth of stock short, but you only have to put up $1,000 as your initial buying power requirement. So essentially, you're taking on a 10-to-1 leverage. Now, how does this translate to what we're doing here? Now, we're trading ES options, right? This is S&P 500 E-mini S&P contract, and the multiplier here is 50, right? So we have to take that into consideration. But this is a $5,900 vehicle, right? $5,900. If this was a stock, this would be a $5,900 stock, right? So the value of this contract is ginormous if we think about it. Just do the simple math, right? Let's call ES is at 6,000 right now, right? 6,000 times 50. That's the multiplier, right? So at the money put option, right, controls $300,000 worth of the underlying asset, right? So $300,000 worth. That's one at the money put. Okay, we're not trading at the money puts. We're trading puts that are out of the money. Okay, so what is the notional risk? Let's say this is a position I am considering putting on today as my tier one ad, right? This is a 1-1-2 structure. I have a put debit spread that's 300 points wide, and we'll talk about that in just a little bit. But I want to focus on, right, the naked puts. There are two naked puts in July 31st expiration at $5,100 strike. Let's do the math again. So 5,100 times 50, right? The multiplier is 50. That's $255,000. So each one of these puts has a notional value of $255,000. If I'm selling two of these puts, right, we multiply that by two, we get $510,000. So if I sell this 1-1-2 structure, my two naked puts have a notional value of $510,000. That means I don't have to put up $510,000. We all know that. What that means is that if ES is at zero, which is very unlikely, but if it's at zero, right, we're on the hook for $510,000. Now, the broker is not going to ask us $510,000 up front, right? They'll ask for a significantly smaller dollar amount, right? And therefore, we get the leverage, right? We get to control a lot of potential underlying asset for a fraction of the actual notional value of that contract, or multiple contract in this case. So let's talk about this put debit spread. So if I'm on the hook for $510,000, right, for these two naked puts, well, I have a put debit spread, right? This is a 300 point wide put debit spread that could potentially offset some of the losses, right? We know that if ES goes to zero, well, our 5,4700 put debit spread is going to be at its max value potentially, right? And the most this 300 wide put debit spread can be worth is 300 points. So we multiply 300 by 50, right? Multipliers 50. We get $15,000. Okay, let's just assume everything went to zero. And I do realize that, they're in different expirations, and right. So in by July, let's say if ES goes to zero in July, odds are this $5,4700 put debit spread isn't going to be worth 300 points, because between July and December there's still time, and as long as there's time, right, this put debit spread could potentially end up out of the money at expiration, so it's not going to be worth its full value. Otherwise, there would be no one to take the other side of that trade. So, but let's just assume that, for simplicity, right? Let's just assume that everything's at zero in December. What's our actual loss here? What is our actual loss? So if we're holding $510,000 worth of ES puts naked, right? So we lose $510,000 with the naked puts. That $510,000 loss gets offset by the $15,000 from the put debit spread. Okay, so we're still out $495,000. Okay, so $495,000 is what the notional value, right, of this position. Now, if you go to Tasty or if you go to Schwab, Toss, or whatever other brokers you may use, I know Interactive Brokers is slightly higher on buying power requirements, and some people don't like that. And I know that in a calm, steady, bullish, rising markets, right? We want to go to brokers that take up the least of the buying power, right? Because we want to utilize the leverage and put on more positions and so on and so forth. The problem here is that let's just use Tasty for this exercise. So in Tasty Trade, if you put this trade on, I believe that the buying power requirement is going to be somewhere around, $15,000, 1.5, right? 15 grand. Okay. So we get to control about $495,000, right, of the underlying asset with only $15,000. Can anybody tell me what kind of leverage we get here? If I gave you control over $495,000 worth of the underlying, and all you had to put up is $15,000. Well, you can just do the math. It's 495 divided by 15. You get about 33 to 1 leverage in this position. 33 to 1. Okay. So now what happens is, well, Tasty asks for only $15,000. That's a very that's a very little dollar amount to get involved, right? We can say, well, if it only takes 15 grand to get in, I have a, maybe let's call it a $300,000 account, right? $300,000 account. And if I'm only going to spend $15,000 to get involved, I have, $285,000 of cash left over, and it's not working, it's not earning, so now we're looking for ways to push more chips in the pot where we are blindly increasing our notional risk, right? We're already getting 33 to 1, right? Notional leverage. If we compare how much notional risk we're taking on with how little it takes to put the trade on. But let's just say I have, a $300,000 account and I'm taking on a $495,000 notional risk in this 112. We'll divide 495 by 300. Right? So we get about 1.65x leverage, right? So not quite 2x, right? But just so we understand how much risk we're taking relative to our net lick, just doing one tranche of 112 in a $300,000 account with a $15,000 initial buying power requirement, we're taking a 1.65x leverage, which is not really, it's not super aggressive, but we're already, 1.5 times X leveraging our account. Now, the next step, this is where a lot of retail folks make mistakes, is they're saying, all right, $300,000 account, I am going to use maybe 30% of that for my 112, right? So 300, that's 90,000, right? 300 times 0.3. If it only takes about $15,000 to get involved, or the initial buying power requirement is 15 grand, so we divide 90,000 by 15,000, we get 6 tranches, right? So assuming that each tranche will take up $15,000, if we do 6 of them, we will have used $90,000 of buying power. That $90,000 of buying power used is going to represent 30% of the $300,000 account. Hopefully that makes sense, and hopefully I didn't lose you guys along the way. Right? But now think about this. So if every one position has a $495,000 of notional risk, and we have six tranches on, right? We're trying to maximize, or we're trying to, use our buying power as efficiently as possible. So we put on six tranches. They don't have to be all in one or the same expiration. They don't all have to be put on at the same time. We could have possibly spread them around, but let's just assume six positions. Each has $495,000 worth of notional risk. That's $2.97 million. It's almost a $3 million notional risk in a $300,000 account. Now we're essentially leveraging our account almost 10x, right? Because if we take 2,970,000 divided by 300,000, we get 9.9. So let's just round this off. This is a 10x leverage of your account. That's aggressive, right? Odds are, ES is not going to go to zero, right? So all this leverage is it's aggressive. 10x notional leverage is aggressive, right? We can draw a line at 5x maybe, right? But 10x leverage, and then we don't really realize that, right? If you don't think about it like that, you don't realize that you just leveraged your account 10x with ES 112s, while you only try to accomplish is get to that 30% buying power usage of your available buying power, right? So you think that you're doing, and I'm not saying that this is bad or this is wrong, or look, you could take as much leverage as you want. I'm not here to tell you how much leverage you should be taking. I just think 10x leverage is very aggressive, even though you have the buying power to do it. You don't really look or take into account how much notional risk, how much exposure you're getting, right? And all you did is you put on six positions, you got to a 30% usage of your buying power as your goal, which is totally fine. But the leverage, right? This is a very, very, I don't want to say expensive, but this is a high priced underlying, takes a lot of dollars, right? And the only reason why, right? The only reason why we end up falling for this trap, right? How do we get here? Is because tastytrade, and I'm not saying they're bad guys, they only take up $15,000 to put on a $500,000 position. I mean, is it wrong? I'm not here to say that, what's right and what's wrong. I just I just want to make you guys aware of the leverage, to how much exposure you're getting with the little dollars that's required to put this trade on. So what happens is Tasty lets you put on this trade with very little upfront cost or buying power usage, right? The underlying starts to go down, volatility starts to go up. Tasty Trade knows the risk is real, even though ES is not going to zero, but they're going to ramp up that buying power really, really fast, right? Now, imagine this scenario. If, let's say, Tasty, instead of asking for $15,000 to put on, $495,000 notional position, what if they ask for 50 grand, 50, right? You're only getting 5 to 1. Well, that's not bad, right? That's not, I mean, it's still, pretty decent leverage, but the more money you would have to put up front, yes, the customers wouldn't be happy because they cannot put on size anymore. But what would happen is, if you had to put up $50,000 instead of $15,000, as the market or the underlying starts to go down and volatility starts to rise, we know that volatility will eventually go away, but your buying power requirement wouldn't skyrocket. That's number one. Number two, you would never have six positions on, right? Because let's just go back to the same example. Hopefully, you're still with me. we're still trying to allocate $90,000 of buying power, which represents 30% of our account, right? 90,000. And what if that 112, instead of 15,000, took up 50,000? You could only do two and you'll be already a little bit over your target buying power usage, which is 30%, right? So instead of having six positions, you would only have two. Okay. So let's just round this off. Each position has $500,000 of notional, right? That's $1 million. So you're holding $1 million worth of notional risk in a $300,000 account. Now your notional leverage, right? We're comparing notional value of the positions that you're holding relative to the net lick of your account. So we divide 1 million by 300,000, you get 3.3. It's not 10x leverage, it's 3.3. I mean, I don't need to ask, silly questions, but which one do you think is safer? Leveraging your account 10x or 3.3 times? I think the answer is obvious here. So you get the safety, right? If you had to put up more money, you wouldn't be able to put on as many contracts. And then obviously you wouldn't have as much trouble if the underlying started to go down, if volatility started to spike, and so on. Now, on the flip side of that same coin, if you only could put on two positions instead of six, right? Well, you're only generating a third of income than you would otherwise. Does that make you happy? No, right? Does it mean that the broker is bad? I don't think so, right? If they did that, and we've seen this before where, out of nowhere, the broker would increase buying power requirement and we get the messages and people are complaining and asking questions. Why did my buying power, spike over the weekend or whatever the case may be, right? And they can at any time raise, buying power requirement to whatever they want because look, they're holding the risk for you. They want as much of your skin in the game as possible. So yeah, they can raise, but if they just started with a higher buying power requirement, I feel like the retail investors would be less of a, I don't want to call it prey, but they wouldn't put themselves in the positions a lot of times they put themselves into because they don't really understand the leverage and the notional risk. All right. So again, this isn't, to scare you guys away from trading 112s, right? Whether it's a 111, whether it's 112, whether it's all in the same expiration, or if it's a calendar spread, there's many ways to do this. If you are concerned, if you're not feeling comfortable after hearing me say what I said today, then you should definitely consider doing something along the lines of a defined risk trade, 1122, 1133, whatever the ratio may be, where, you kind of have control over how much money is at risk from the beginning. Because again, here, we don't know what the actual risk is, right? Maybe ES doesn't go to zero, but at expiration in July, we're going to look at the price of the underlying minus whatever the strikes in our short puts, and that's how we figure out what the actual loss is. Right? We don't know, if ES is at 4,600, we could assume one potential loss in the account. If it's at 4,800, it's going to be a different number. But when you're doing a defined risk trade, right, you know exactly how much buying power or how much risk you're putting on, right? And assuming, right, that you don't, assuming that you don't lean on using the leverage that you may be getting, even if you're trading ES in a defined risk trade, right? Your buying power requirement may be lower than your total risk. That's just how, span margin works. But if you are doing defined risk trades, just assume, whatever the difference between the strikes plus minus credit or debit that you're paying, that's your risk, right? Use a higher number and just, be a little bit safer. Also, I think what makes sense is that, look, if you just for yourself to protect yourself from you, right? If the broker wants $15,000 to put the trade on, why don't you just plug it into your calculator that it wants 30K instead? Yes, you're going to be able to put on only half of the positions that you would put on, right? Which means that, you're probably only going to leverage your account if you hit that 30% allocation, maybe 5x notional risk. Okay, it's not 10, right? You are not going to be able to put on as many 1, 1, 2 positions. Yes, I know that. What that means is that you will have to find other underlyings, other strategies, right, to go with to diversify away from being super concentrated in one position or um, in one strategy with that same one underlying, right? Like if you have already, 4x notional risk or 4x notional leverage to your account size in ES, whether you're doing a 1, 1, 2 or whatever else, that's only going to increase your notional risk, and that's going to affect your notional leverage. You can no longer put on any more ES positions. So now you will, I mean, going from ES to SPX or going to from ES to SPY, do you really diversify away from the risk of this underlying asset? No, you're just using a different instrument, but you know, and maybe you need to instead of going from ES to SPY, maybe you need to look at trading gold or bonds or oil or whatever else it may be, right? So this is how you kind of protect yourself from being too concentrated in any one underlying or in any one strategy. I think it's more concentration in an underlying, right? Because whether you do a 1, 1, 2 or a strangle, if you cannot add any more notional risk in yes, doesn't matter what strategy you're trying to do, you can no more or you could not add any more ES trades until some of that notional risk comes off. So it's more about being concentrated in any single one underlying asset. So do you understand what your total notional risk is and how it relates to your overall net lick in your account, right? What kind of leverage you're taking on. I think 10x is very aggressive. I think 5x is kind of where you kind of draw that line, right? 3x is probably more like a reasonable target. So try to do what you can to keep your notional leverage down. And I think that, there's always two sides, right? Keeping your notional leverage down is great. You will do much better during the times when the market's selling off or volatility is increasing and whatever the case may be, right? You give yourself a lot more room before you have to deal with something like a margin call, right? And that's great. On the flip side, you're not generating as much income. So do you settle for less income with less potential, notional risk, or do you just find other underlyings to trade, right? Hopefully they're not correlated, and you make up for whatever you're missing out on ES. Maybe you're, picking up that income trading gold, oil, bonds, or currencies, whatever else you guys like to trade. All right.